From Washington, this is the Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Friday, May 6th. You're listening to the Macrocast, brought to you by Markets Policy Partners and Hamilton Place Strategies. A big jobs day, as they're all big jobs day. This is a pretty significant one. It's the biggest one until the next one. Matt, we had some solid numbers today. Matt McDonald, Matt's obviously, as you all know, with us every jobs day. We're also going to have Brai Odion-Esene with us during as Brai is with us on FOMC week. We had a double header this week with both the FOMC and non-farm payrolls. Matt, the numbers were pretty solid mostly, right?
It's pretty solid. I think, Tony, I think your characterization of the most important one until the next one is probably right. I don't think anything in the jobs number here. The jobs number this week to me feels like context for everything else that's going on. That's not necessarily like changing the context itself, but the headline is 428,000 new jobs created. Prior month's revisions were down a little bit, down by about just shy of 40,000 jobs revised down. The unemployment rate was unchanged at 3.6%. Just to put that in context, unemployment rate prior to the pandemic was 3.5, I believe. A couple of the points that people were looking at closely, labor force participation rate was 62.2. Again, that's still pretty well below the 63.4% participation rate that we saw before the pandemic. But that was some years ago now, to be honest. And like you're going to get an aging effect in the labor force participation rate over time. So what the counterfactual is or what it should be is not necessarily what it was before. Wages, obviously, from an inflationary perspective, that's something people are tracking. The average hourly earnings were up 0.3% on a month-over-month basis. That's 5.5% over a 12-month period, which is kind of in keeping with where we've been. I don't think that changes a ton. Looking under the hood on the numbers a little bit more, a lot of the job gains were driven by the services sector. I think that's going to continue for a while. I think 78,000 jobs were in leisure and hospitality. You continue to see kind of healing post-pandemic. On the unemployment rate itself, while it was unchanged, the only noteworthy piece as I was going through it was unemployment rate for Black Americans dipped from 6.2 to 5.9%, which I think is the first time kind of post-pandemic that's a 5 handle for that group. So that's kind of the overview. I look at this and it's a really solid number. It's worth pointing out that this is, I think, the 12th month in a row where we have over 400,000. So, but again, as everything is kind of context of inflation and the Fed and where the broader economy is. So my guess is that it's a solid number. It's a solid report, and people probably won't be talking about it for very long.
Yeah, Brendan and John, it's coming in the context of, pretty wild markets over the last couple of days. And so I think there was a little bit more nervousness going into the number this morning than you might otherwise have expected, because it kind of feels like we're on, a little bit of something like cruise control on job creation right now, where there's sort of it seems to be more or less steady return to work, or at least job creation, whether it's return or not return. We don't really know. On the labor force participation rate, I don't think anybody really knows what the number is supposed to be. Yeah, who knows?
We'll wait till next month and the month after that to see if that's real. So I wouldn't make too much about the labor force participation. But you are right.
I just think it's a big shrug emoji. Like, who knows? Yeah.
I think it is a good sign too. When you look at the jobs that were created, they're going back to the normal economy, not the COVID economy. Like people are working at hotels again, and people are working at restaurants again. So that's a great sign.
Yeah, and from the other sort of market salience of this number really is, if you're looking on the horizon for trouble, if you're thinking that the U.S. might be going into a cyclical slowdown or something even worse, there are obviously people that are nervous about recession. Those concerns, growth concerns, are obviously more acute when you look abroad overseas at some of the data coming out of Europe and China.
Yeah.
But this labor market data, as good as it is very backward looking. It's labor markets are sort of the classic lagging indicator. And if you are concerned in the markets about the Fed over tightening and a cyclical slowdown and the sort of stagflationary pressures taking the wind out of the U.S. consumer, you're not going to see it in these numbers. And so there was a little bit of nervousness about the average hourly earnings perhaps coming in on a really hot basis. And this is after yesterday's esoteric numbers came in. The classic kind of lead up to the non-farm payrolls, you get the ADP on Wednesday, and that was pretty solid. And then you get the day before, you get the last week's initial jobless claims. That looked pretty much in line as well.
Yeah.
But the non-farm labor productivity, that's an econ data point you don't talk about that much.
Yeah.
And it just landed with a huge thud yesterday.
Yeah.
I mean, when you look at that, Brendan, that was sort of part of the stagflationary warning signals that flashed on the dashboard yesterday. Not saying that was the reason for the swoon in equities and the sell off in treasuries, but that was a bad data point, right, Brendan?
Yeah, unit labor costs were up almost 10%, and our output slowed. A bit of that was the quarter over quarter change because we're coming off of huge, growth, and people are making more money. But going back to the inflationary point, and Tony, I'd be interested in your take on this. Wage growth, you can view it. Some people are saying, it's a wage growth with 5.5%. And you can say, wage growth is not keeping up with inflation. On the flip side, wage growth could be the leading factor, and that could be actually a good sign. So wage growth has kind of stagnated the last 3 months, which could also be a sign that inflation has peaked and employers aren't having to pay more to retain workers because inflation is
wait. I want to get in on the schizophrenic hot takes that the market has been producing all week. So let me get in on this. Okay, so the good case for today's jobs report is that the Fed is going to have to keep tightening to get inflation under control, but the economy is strong, and so it will be okay. The bad take is all the Fed tightening, the job market is still running hot, and we will never get inflation under control until it starts to cool a little bit.
Every time I see these hot takes and I think about them is there's a movie. Did you guys ever see Glory Road?
Yeah.
Basketball movie. There's a great scene where the black basketball player is teaching the white basketball player that bad is good. Bad is bad, bad is good. And the wage growth becomes this bad is good, but
unless it's good, you don't know.
It's good. Yeah. And so, yeah, I agree. But so the numbers were 5.5% year over year. Year over year. And inflation is 8.5% year over year. So that's, so the quick take is that wages are, running about 3% behind inflation. And so, do you take comfort that wages we're not getting cost push inflation, wages driving, pulling inflation, and instead lagging. And so will they both revert over time?
I want to hear Brai. Brai's escalated hot take on this. You need to
have to be an escalated hot take by Brai, or it's not worth it.
Well, actually, I think I'm in Matt on this. I think the fact that even with a negative GDP number, the Fed was not deterred from what they did on Wednesday. Just shows that the underlying economy is good. Right, things are things are not as bad as people want to think they are, and I do think I am a believer in the soft landing. I'm in that camp where I do think they can manage this and tighten things a bit and bring it in. And I think people have to remember that a lot of things that are happening have nothing to do with high interest rates. Right, it's like supply chain disruptions, Russia's invasion of Ukraine, the ongoing lockdown in Shanghai that might stretch into June based on what I'm hearing. These are things that aren't it's not an issue of like diminished demand or.
That's true, but Brai, those are also things that are like out of Fed control. So
exactly.
I tend to fall into your camp too, but my worry is that things have to also break their way in ways that they have very little control over. You know? Yeah,
no, and I think that's the X factor, right? Is that they're doing all this, and I think Jay Powell acknowledged that during a news conference he gave, where he said, "Look, there are things that we can do, and there are things that are out of our control." And I think everyone is collectively crossing their fingers and their toes and just hoping that we see a resolution on at least some of these things over the next 6 months, knock on wood, that might, like you said, Matt, break the Fed's way. But I think honestly, for me, the biggest X factor is the war in Ukraine. I don't see that.
Yeah. So, Brai, let me ask you, if on Monday we wake up and the Russian generals overthrew Putin.
What Russian generals? Are there any?
I mean, but it could happen.
Hypothetical.
Oil will be down $30-$40. What does Powell then do?
Well, so here's the thing, though. The damage is already done, right? So even if this coup happens and, oil prices and gas prices overnight drop, there's still the massive disruption to commodities that we've seen, right, from like the war already. So that effect will still be there for a bit until things get under control. So yeah, I don't think an overnight coup would solve things quickly.
The soft landing, soft, Brai, or soft-ish? Chairman Powell says he indicated there's a soft-ish category too that we could be in for.
I mean, I think it's like, and I hate to, I dislike analogies, but it's like, when the pilot lands the plane and it does a little skip, before coming to a stop. I think it'll be, so I guess soft-ish maybe then is a better description.
Are we going to be swinging left to right to avoid like wind shear too?
Exactly. Right. All the headwinds that we're facing. Yes, there'll definitely be some maneuvering that needs to happen.
That's a lot. There's a lot. I was in a debate with some former economic policymaker friends about sort of the grade on Powell, and I'll tell you, like, I was alone in acknowledging that they're obviously behind the curve. I mean, anytime the Fed is above, anytime inflation is running above or below the Fed's target rate, they are by definition, behind the curve. That's what it means. And so it's kind of axiomatic that way. At the same time, they were like such harsh critics of him. And my feeling was, we're doing things that have never been done before in conditions that have never been done before. And so, a little bit of humility for, the certainty on direction on these things, I think is needed by everybody. I mean, there are just a lot of things we really, really just don't know.
That's absolutely right. And, one of the things I want to get Brai's reaction to this, but where everybody's really picking on Jay Powell is he's talking about the labor markets, very tight, expeditious rate hikes, normalization of policy, inflation way above target. It's way too high, and it's falling on the lowest, the least able to bear it. And then Steve Leisman asks him, well, how about 75? And he's like, no. And we're not even talking about 75. Right. And that's like a total layup. All Jay Powell has to say is like, we're going to hike rates at the exact right, at the pace that we need to. The pace right now we think is good for the next, coming months, but we're going to be that just seemed like, and there are people that say, well, that's why the market slingshot northward and created all this. What's your reaction to this line of it's very popular line of criticism these days, Brai?
So I think, and I was fortunate enough when I was back in my reporting days to have met Jay Powell in an off-the-record setting. And honestly, I think he's a pragmatist. He's not an economist by training. And so I think the way he sees it is that as things currently stand, they aren't thinking about 75 basis point hike, right? Now, down the line, could that change? Sure. And he will telegraph that if that moment ever arises. I think that's how he operates. Right, he tells you as it is. He does not do economic speak, right? And I do think, and this is just my opinion, I do think there's an inherent bias against Jay in the economist community because he's not one of them.
Yep, great point.
I do think they do judge him for that. But frankly, I'm glad that in this situation we're dealing with, we've got someone at the head of the Fed who's not bound by any sort of like school of thinking or ideology or whatever you want to call it.
Or his model,
Right, yeah, exactly. And so he will steer the ship based on what he sees right in front of him and will not, let anything else interfere with that. So I think it was fine what he said, because as things currently stand, he was telling the truth that they're not thinking about 75 basis points. Now, if down the line things go pear-shaped, right, and they need to move faster, then that could be on the table. But I think him just being blunt, sure, the market, it caused the reaction of the markets, but I think it also gave people clarity as to the Fed's current thinking.
Was there anything else? I mean, if we just switch to Powell and the FOMC meeting, anything else that surprised you came out of any of you on that from clearly on people focused on rates, but anything on roll off and purchases? Was that pretty much what we expected?
I think that was pretty much what was expected. There was a sense of, maybe it would be a couple more steps or whatever, but a phased in approach to the 95 billion. So that was pretty much right down the fairway. But I think when it comes to quantitative tightening, we get a lot of questions about quantitative tightening from our clients. And it is it's a very untried kind of policy. We've only really done it once. It was 17 to 19. And that coincided with a really, solid economic boom really at the time. And so, what is the impact of it? That's a big question. And, the on Wall Street, of course, the equity crowd, very biased to the upside, you say, well, quantitative easing, what do asset purchases do? They say, well, it's rocket fuel for asset prices, sends them right up. And they say, well, okay, then when you put that policy in reverse, doesn't it do the opposite? And they're like, not necessarily. So there's a lot of cognitive dissonance on it.
Yeah.
Like, is it bullish for long-term treasuries? Because, because it's something it's tightening and it may have a lower growth and inflation profile down the road, or is it bearish because you're, adding back duration onto the market? It's contextually, dependent, I think. I mean, Brai, you probably have a more sophisticated assessment of it based on.
Well, I was going to ask you guys for your thoughts. Like, what do you think? Because I've seen some commentary about this, but I've never been able to get a definitive answer. Like, what does this mean, or what would the Fed, the Fed's slow exit from the treasury market, what would that mean for government borrowing going forward, or government debt issuance going forward? Do you think it has a material effect, or they've already baked this in and they can plan around it?
I think that's just driven by other considerations, and the extent to which the Fed is in the market. If it's if the Fed is in the market purchasing treasuries, does that make it easier for us to run deficits? I guess the classical formulation would say, yeah, it does, because there's a source of demand out there. But the question is, is there a source of demand that is going to step in readily from the Fed? And that's a very testable proposition at this point. And one of the big factors yesterday.
Yeah, we're certainly coming off, though. We should note that fiscal deficits are coming significantly down.
It's down $350 billion from a year ago. So we're just issuing way less debt than we were, because we're not doing the COVID stimulus like we were before.
Yeah, so there's less need for it, and it seemed like there's still remains lots of global capacity, global appetite for U.S. Treasuries. So I don't think that's going to have a big impact. I mean, rates are going to go up because that's where the Fed wants them.
Yeah,
the Fed wants them to
goal,
go,
right?
Yeah, and Powell's paying attention as he said it. He emphasized it again that their gauge is financial conditions, and financial conditions is measured by the 10-year is what, 3.1 this morning.
It's above 3. And also the 2 10-year yield curve has been steepening for the last week.
Yeah. So the market is doing the work for them.
And mortgage rates, the 30-year mortgage is, about 5% there.
Right. And it seems to, if we've seen sort of just some of the early anecdotal readings on refis, on and mortgage applications. I mean, it sounds like it's having the intended effect of slowing down housing. There are lots of things slowing down housing, which is the fact of like as Zillow reported yesterday. I wanted to ask you guys about it, or was that yesterday or today? The Zillow reporting, or
it was today, yeah.
Today, yeah, and and there's no supply, right? I mean, like you go on Zillow and
Zero.
It's like a map. Yeah. It's a map. Like there are no homes for sale on it, And,
but you're right. So refi has completely dropping off a cliff because everyone already did the refi, and new applications are down 67% from the peak, which the peak was just a few months ago. And then if you want to buy a house, we haven't built many. And now if you're locked into a 2.25, 30-year mortgage, your bar for moving is pretty high, Yeah,
it's pretty sticky, right? I mean, if that's what you paid for, if that's a mortgage that you've got, I mean, you're trading it for something up around 5% now.
Exactly.
Wes, were there any other data that surprised you this week?
Well, I think the European data was awful. The same with the Chinese data. We focused so much on the Fed and the jobs number this week that I think the noise was a little. We didn't focus so much internationally. The European data was awful. The Bank of England raised rates to 1% and said inflation is going to be really high and growth is going to be really low. We don't think it's a recession, but basically growth is going to be zero for.
The pound took a beating on that.
Yeah.
And this is already, at very low levels over the recent range. It's when you, as we mentioned before, when you look at the U.S., it's, there's some question marks around the future growth and that sort of thing, and some noise in the data, particularly the forward-looking stuff. But you look overseas, and the picture is just a lot bleaker. And obviously closer to the conflict in Europe. And so forth. But one of the things to pay attention to next week, it's sort of off the radar. It's Chinese monetary aggregates and credit numbers. So Beijing has been talking about stimulating the economy. More and more Chinese officials have been coming out and saying, we're going to hit our targets. We're going to hit our growth targets. And, not really giving out specifics on what they're going to do to accomplish that. But this is how you would typically see Chinese stimulus. You see it in these credit numbers, in these monetary aggregates. And, we've just seen over the past few months, very high ranking Chinese officials talking up and jawboning the market, but really nothing concrete that could really move the needle in terms of growth. And so
they're leaning even harder into the zero COVID policy.
That remains a major issue and a question mark around, the reverberations through supply lines. The questions about, have we only seen the beginning of the supply chain shock that's coming from this lockdown? And that's a scary question, particularly given that we've seen the consequences of supply chain entanglements to give us this level of inflation.
Yeah, and one thing that came up in the conversation I had with a client earlier this week about the Shanghai situation was that he was saying, look, right now, everything that's coming out there is coming out at a trickle, right? Eventually, at some point. And he was saying from his suppliers in China that this lockdown might be in place until June. It's like eventually when that's lifted, you're going to have a flood of products competing for very limited space on ships leaving Shanghai to come this way, right? So then everything's going to get backed up even worse because now you have things are reopened, but it's not enough space to take everything at once. Or, and so that's where his concern is that we think it's bad now. It's about to get worse once the lockdown is lifted.
You should see more. It's interesting because you see go the other way too, right? Because you should see more energy demand from China as well. It's just. I mean, that's a great example. China alone is just one of those great examples of how hard it is to wrap monetary policy around conditions around the world. Like, how does that feed into a Taylor rule model? Fit China, lockdown, supply chain, restart flooding with retail products and then sucking in energy again, starting in June. Put that into your Taylor rule. Where does that go? Like, I don't know. You never know where it fits on the equation, right? It doesn't.
You're 100% right. And everyone that's criticizing Powell is then telling him to tighten into a supply constraint economy. That can bring down inflation, but the way it brings it down is by sucking growth and we go into recession. They don't say that part of the sentence,
That's why I said ish. or but no recession. I thought he was, he was asked about recession, and I thought he was very careful. I thought he was very careful in how he talked about it. Obviously, because you don't want to frighten people into a recession either, and he didn't want to be looking back, and saying there's not going to be a recession, and then see it coming. And I'm with Brai. I'm in a camp of like that they are going to be able to land this plane, because I still think the kinds of things that he talked about, the very strong balance sheets, both business and households, 3.6% unemployment is a real thing. 400,000+ job creation every month is a real thing. And it's just really hard for me to see an actual recession in that, in this environment. But certainly if they start throwing around, 75 basis points policy rates, I could definitely see that happen, but it doesn't look like he said it's not on the table, and I don't see it on the table. And I think they're going to get something, they're going to work their way closer to neutral. And I think this economy will be just fine. I'd feel differently if we were at today, if we was at, if we were at 5.5%, 6% unemployment and looking like it might edge higher. If that's what we were looking at, I'd start worrying about stagflation and recession. I don't understand stagflation with 3.6% unemployment rate and 400,000 job creation.
Also, we talk about, the stock market. The last couple of days have felt horrifying with the moves, but the S&P is actually still slightly up on the week. So you got to keep things in perspective too.
Absolutely. Yeah. I'll tell you, I was in a courtroom with a client yesterday, and so I emerged back in, you don't have your electronic devices with you, so I wasn't able to look at the markets till 2:00 as I opened up my phone and 1,500 points. And I had to quickly, rush over to Twitter and see, like, did war break out somewhere? Yeah. I mean,
Well, it's tough. I mean, these days it's really tough. The conflation, we've talked about this before, the way in which financial conditions and equity prices have been conflated, risk asset prices have been conflated to a degree to which, and we've just seen this over and over again, because every time, when the Fed put was in place, whenever risk assets and equities would fall, the Fed would say, look, financial equities are falling. That's a big tell for financial conditions tightening. That is our cue to loosen. And the formulation we have now is a lot of investors saying, hey, if the market goes up, that's telling Jay Powell that he's not doing enough. And so we've called this the green means go, which is, if the equity market goes up, the Fed's going to go faster. And that's a formulation that obviously, the Fed isn't staring at the S&P tick for tick trying to make policy around it. But it is a major indicator and a day-to-day indicator of financial conditions that they certainly do pay attention to. So a lot of investors are thinking, the Fed wants the market to go down. It's a feature, not a bug.
Well, I think it's fair to say, especially following lockdown and the stimulus checks that a lot of people got in their pockets that they then invested in the market, that there are a lot more people now who are invested in the market, right? So it is more an indicative of people's wealth than it was in the past. I mean, in the past, there was like less people who had money in the market. Now it's more democratized. So it actually does, have some bearing on people's bank balances that it used to.
All right. Anything else out of this this week that we should be thinking about? I think we covered it.
Yeah, just the last few points. The European Union coming together for a Russian oil embargo, that has put a floor. Well, it's obviously oil prices are still high, but that kind of talk has kept a floor under oil prices and propelled them higher this week. Even amid all of the downside yesterday, oil prices were up, and you usually don't see that very much. And this is also coming as the Senate committee has passed the NOPEC bill, which opens the cartel to potential antitrust action. This is not new. It doesn't tend to make it through, but maybe the conditions are different now. It's something to cast an eye upon.
For sure. I'm going to see oil back up over right around, I think, June WTI up around above 107 now, I think. And definitely worth keeping an eye on. They're going to do it gradually throughout the year, but everyone knows the direction, and it's good and for all the right reasons. But yeah, there's been continued pressure on oil. What about next week? What data we have?
Well, on my front, the biggest thing is Liverpool has a chance to win all the 4 big ones, and it looks like Chelsea's going to be sold to an American. So things are looking good.
Just pick a man while he's down.
Yeah, Brai, do have an update there?
Well, we're in the FA Cup on next Saturday playing Liverpool, so that should be interesting. As far as the ownership goes, at this point I'm just like, no news is good news, just because I don't want to think about it. So I've just sort of just tuned out all news of the Chelsea sale until it's final.
Fantastic.
It's coming soon.
Yeah. Next week, Brendan, you better be focused on UK Premier League football, because if you follow our Boston teams here at home,
things aren't. Well, actually, the Celtics are doing okay, but
that's okay.
Our Bruins are and our Red Sox are not looking too good right now.
Yeah, next week we've got CPI and PPI in the U.S. So that's definitely in focus.
Yeah.
It's gonna
and honestly, those are more important than the jobs number.
Absolutely.
Because like you said, I think jobs is kind of on cruise control. The jobs market is strong.
Seems that way. I mean, it's been pretty easy to, throw up your non-farm payroll guesses last couple of months. Even if revisions, revisions have had to make us right sometimes in retrospect. But yeah, I think that's the case. All right, guys, great show, Brai. Great to have you, Matt. As always, huge thanks on the non-farm payrolls day. John and Brendan, have a great weekend. We'll talk next week.
Thank you for listening to the Macrocast. Please remember to subscribe, rate, and share.